Good day, ladies and gentlemen. I hope you're well. So, in this live stream, we'll be talking about Bitcoin's first God candle with a body close of 10,000 US dollars. We'll also be talking about the Clarity Act, the Japanese election, and what all of this means for crypto and Bitcoin. So, Bitcoin is currently trading around about 68,000 US dollars. And for the first time in history, the price of Bitcoin fell below the price it was on election day. It's not done that before. And it's another way that this cycle has changed from the previous ones. With Bitcoin falling to round about or just under 60,000 US dollars, it's undone all the gains that it has made over the last 15 odd months. Bitcoin's price has been falling since the all-time high in October 2025, and it's tanked the shares of many companies that have increasingly invested in Bitcoin. Bitcoin's market cap was 2.26 trillion on the 6th of October, and today it's dropped since then 36%. There's a number of reasons why Bitcoin's price has fell, and the direct cause of it mainly is a massive wave of liquidations and also macro events. So what is a liquidation event? So a massive liquidation event happens when a lot of traders are using leverage, borrowed money to trade Bitcoin, because many traders enter around the similar price zone. Their liquidation levels often end up being clustered in the same area. When the trade goes against them and price hits that zone, the exchanges automatically close their positions to stop their accounts going negative. If a large number of positions get forced out at once, it creates a massive liquidation event, and that sudden forced buying and selling causes a huge candle on the chart. People are leveraging at the same zones because most traders watch the same charts, they use the same indicators, and they take the same obvious setup. So their entries and liquidation prices naturally cluster. And it's made worse by round numbers like 70, 75, 65, all the rest of it, which attracts orders. Similar leverage, they also use similar leverage 10, 20%, 10 or 20x, which puts liquidations levels again closer together. Stops and liquidity stack up also near key support and resistance levels. Now, obviously, there was a lot of macro reasons for the God candle as well. The Fed, as we spoke before, has signaled that it will not be rushing to cut rates. The markets were spooked by the next Fed chair nomination. Gold and silver had dropped margin requirements that force traders and funds to either add cash or cut positions. Now, when margin calls hit, people sell what they can fast to raise cash quickly. Some investors dump Bitcoin because it's highly liquid. That selling pressure with the leverage in crypto triggers this liquidation cascade, because once the macro shock starts to push prices down to key zones, the mechanics take over. So you get price drops, forced liquidations, more selling, bigger candle. Excuse me, bigger candle. This was, I'm just going to put this up right now. So this here, the large, big red candle, was one of the biggest ever. It was likely the biggest open and closed body candle in dollar terms. Up until now, the open and close was more than 10,000 US dollars. Now, previously, notably in 2021, we have seen candles with a move of 10,000 or more. We have seen good candles, but that's if you include the wicks. The next day, obviously, we had a large green candle, because what goes down must come, well, normally does come up. So with institution, sorry, Bill, I forgot to I forgot to introduce you. I do apologize. We have the lovely Bill Noble with us today. I do apologize. Hello, Bill. How are you today?
Hi, I'm good. Thanks for having me.
Awesome. Thank you for being here. Thank you for being here. We love your expertise and we love having you on the channel, and in this show in particular. So, Bill, with institutions coming into the space, we were expecting to see less volatility. Now, I remember the 2021 bear market very well. There was a lot of volatility. There was many backs on events. There was Luna, there was FTX, Voyager, 3 Hours Capital, all the rest of it. We were expecting to see a little bit less. Obviously, we can't get rid of them because this is crypto. Were you expecting, or are you expecting something similar this time around? Or do you think with the governments and institutions buying, we're going to have less volatility?
Okay, so this great myth is being exposed. In other words, the myth is with Wall Street entering crypto, crypto will be more stable. So let's think about this for just one moment. Crypto is not backed by the Fed. At the end of the day, US Treasuries and stocks are backed by the Fed. They're not going to let them go down 70%. Crypto is not backed by the Fed. Matter of fact, crypto's liquidity mechanism was hurt by what happened at Binance last October. That's point number one. Point number two is throughout the history of Wall Street, some of which I've been able to see firsthand, we have things called men behaving badly incidents where traders and funds simply blow up. They get over leveraged. Their computer models stop working. That's what happened in 1998. You're familiar with the Big Short from 2008, where these huge amounts of securities that simply broke were on the balance sheets of every bank. Wall Street does incredibly stupid things, especially when it becomes this like crowded, greedy idea. Now, I know that we don't see Bitcoin that way. However, it seems that the Bitcoin ETF is now at the epicenter of a big fund liquidation. For example, this fund could have been short silver and long Bitcoin, or they were just long Bitcoin going back to October, and then all of a sudden they got liquidated. Somebody submitted an application with the SEC to increase the amount of bearish bets that they can make through the Bitcoin ETF derivatives market. So all of a sudden, us little crypto people are looking up at the sky, and Wall Street is looking to rain fire down on us because someone owns the Bitcoin ETF, and that fund might be getting liquidated. So I know we're going to go over this later, but Wall Street is the problem. They are the problem right now, because we all know, at the prior high of the last cycle, it should be an incredibly juicy buy. And it certainly doesn't feel that way today. So, I mean, we'll go through it more. I mean,
and it's so funny, isn't it? It's so funny because I actually never wanted institutions to come in. I know Bitcoin is permissionless and all the rest of it, but I didn't want institutions to come in. I didn't want governments to come in. I was like, this is like a grassroots movement. Anyway, a lot of people did want institutions to come in. Now they've come into the space. I think they've just made it so much worse. I really, really do. What do you think?
Well, I mean, it goes both ways. Look, people get into crypto for hopes and dreams. That's part of why they get into crypto. Some of them are cyberpunks, but there's a lot of people that get in crypto that think it's someone else's job to moon their bags. So have the institutions come in and please moon my bags. Okay, well, that can work when they all pile in, but when someone has to pile out and there's no liquidity, right? Everyone loves free markets. Crypto is a free market. There's no central bank underneath crypto. That's why it can go down 80%. Everyone loves free markets until it actually is free to go do what it wants, which includes going down. So, when institutions all sell at once, we've been covering these markets. We've been covering these huge macro markets like government bonds, precious metals, these things that are making these like statistically once every 80-year type of moves, right? When you have those types of movements in markets, somebody blows up. Now, if that somebody also happens to own the Bitcoin ETF, guess what? We're going to have to suffer a Wall Street liquidation event. So I personally think, and we did a little bit of this morning, that if Bitcoin is ever going to reach its true potential, if Bitcoin is ever going to go to 300K, we may have to push out a good chunk or a chunk of the ETF tourists, right? They're like, oh yeah, I'll do some Bitcoin. And then it goes the other way and they're getting out. Okay. So let them get out at, I don't know, everyone's talking about 30K this morning. I know how you can come up with these prices, and I know, the 4-year cycle math says October's a low, whichever. But Bitcoin may wind up being the cyberpunk treasure that it was intended to be after we push out the ETF tourists. Just that you don't push out the ETF tourists without a liquidation event, and the cyberpunks also participating in that pain.
We had a quick question saying, with governments and institutions' involvement, what will happen to the decentralization of Bitcoin? They can't do anything about it. Bitcoin's too big. There was something called a 51% attack. That's almost impossible now. The network is too big. And, don't worry about the decentralization of Bitcoin. The Bitcoin blockchain itself is absolutely fine. There are obviously a lot of bad characters in crypto who will try to manipulate it. If they could have, centralized Bitcoin, they would have done it by now. That's why they fought so hard against it. Trump as well. I was hearing today that Trump's made something like 3 trillion. Was it something like
3 billion?
3 billion, sorry, not trillion, billion. He's made $3 billion worth of profits. And then obviously his Trump coin as well. That was a massive rug pull. Hello, M Ninja. I hope you're well. Let's go over to the Clarity. It kind of makes you miss Gary Gensler, doesn't it?
Well, we had somebody to rebel against, right?
Yeah. Oh, bless. Okay, let's move over to the Clarity Act. Now, this is quite important. Now, the Clarity Act was first introduced on the 29th of May, 2025. It passed the US House on the 17th of July, 2025. Then it moved to the Senate on the 18th of September, 2025, where it's been held up by negotiations. Now, today is the second White House meeting to break the stalemate. So the Clarity Act itself is a US piece of legislation. It's a crypto market structure bill. It's designed in part to regulate stablecoin yields and also to tell the market in writing what counts as a commodity like crypto token and what versus a security like crypto token. And it gives clear responsibilities to the regulators so the companies and the users aren't guessing what the rules are. Now, a security like token is like buying shares in a project. You're not expecting to, you are expecting to profit mainly off the team and the company who build it, who market it, who run things. Now, a commodity-like token is like buying a digital thing. Its price is mainly moved by supply and demand of the market, not because there's one team behind it doing all the work. And the central goal is to separate the responsibilities from the SEC and the SFTC. Now, the Clarity Act as well, there's another part of the Clarity Act, and that's regarding stablecoin regulations. And the negotiations today are between banking groups and crypto industry reps, basically. And it focuses on the biggest unresolved issue, and that's whether stablecoins can pay yield, whether you call them yield, interest, rewards, whatever it is, if users can earn something by holding stable coins. Now, this is where it gets politically intense because the question of whether stablecoin issuers or platforms are allowed to pay yield, rewards, interests, etc., hits the banks. Banks generally want to limit how much yield can be paid because they see it as direct competition with the deposits that they hold. Crypto firms argue that banning yield will make stablecoins less attractive and less useful. So, this stablecoin yield dispute has been reported to be one of the main reasons the legislation has been repeatedly negotiated at higher levels. The Clarity Act, at its core, is about drawing a a map of crypto in the United States, but where they're fighting over details, and these are very important details, especially obviously the stablecoin yield, who gets to control what question, and that's going to determine whether it actually becomes law or how it's going to end up. So, Bill, with stablecoins, and why is stablecoins and the rewards such a big sticking point, and what's the underlying fight?
Well, as you said, banks have to try to slow this down. Banks are not going to be able to stop this, but they want to slow it down. So the Clarity Act is just like its name. People want to know that they're not going to build all this crypto infrastructure, whether it's stable coins, Bitcoin, ETF, XRP Ledger, whatever. They don't want to build it and then have Gensler come back under a hostile anti-capitalist administration and wipe it all out with a regulatory wave of the wand. Whereas if it becomes a law passed by the U.S. Congress or Parliament, some regulator can't just come in and unwind that. So that's why clarity is important. It eliminates another Gensler. Now, when it comes to stable coins, of course, it's competition for banks. Banks pay lobbyists. Banks don't want competition. You know what? It's too late. First of all, the government needs to issue treasuries to the stablecoin companies. So the stablecoins are going to pay a yield. That's the whole point. They buy the government debt, and then they use the government debt to actually create money. So anyone who thinks that stable coins are not going to pay a yield, they're crazy. The banks are probably just trying to get some concession out of it because the Treasury wants it. The Treasury wants it, right? They have to have it. If the Treasury can't create money, can't print by issuing debt, which then creates stable coins, it's like printing money. If they can't do that, I don't know how the U.S. government functions. So big picture, it's going to happen. I think banks have got a lot more to fear from Bitcoin than they do from stable coins, right? Banks should have to compete for yield. They've been paying U.S. consumers nothing since ZIRP, zero interest rate policy. They've been paying people nothing for, a long time. So obviously on a crypto show, you're not going to catch anybody feeling sorry for the banks, but the banks are going to put up a fight because they, Congress in a large part is bought and paid for on multiple issues. The overriding factor will be congressmen will never get spending for their district if the government can't issue debt. So they can put up a fight. They can do what they want. I think if they limit stablecoin yield, it's going to incentivize the creation of like a Bitcoin yield curve. I know this is complicated, but really the only reason that there's a US dollar yield curve, like there's a 2-year interest rate, a 5-year interest rate, a 30-year interest rate. We talk about this all the time, right? If you just plot them on a piece of paper, that's a yield curve. Well, shouldn't somebody be issuing bonds denominated in Bitcoin? You have bonds denominated in dollars, euros, yen, sterling. We should have a Bitcoin yield curve. Now, Michael Saylor issued some products that pay interest, but those are MicroStrategy products. They're not Bitcoin products. So if they limit the yields on stablecoins, it could wind up backfiring. People could say, okay, well, if we can't have real interest rates over here, real as in like actual, oh, let's go do it over here. Let's do it on Bitcoin. I mean, would you be excited to buy a bond and get rewards or interest in Bitcoin, especially with Bitcoin at 60K? You might be. So, you know, when Wall Street fights these things, it's a sign of weakness, right? Crypto is going to disrupt their business. They could complain all they want. It's going to happen. It's like iPhone and BlackBerry. You are not carrying a BlackBerry device for texting and an iPod for music. You're not. You're going to carry iPhone. Same thing. You're going to have stable coins, Bitcoin, and tokenized securities right here on your phone. Kids need to have a Schwab account, a Coinbase account, and a JP Morgan bank account. No, they don't. They don't want that. So they can complain all they like. Congress can do its song and dance. You know, at the end of the day, Gensler is not coming back, and you are going to have cryptocurrency with interest. It's just a question of which cryptocurrencies.
Mm-hmm. That's very, very interesting. I actually liked it when you said that when Wall Street fights, it's a sign of weakness. And it is, because like everything's evolving quite quickly as well. Banks should have seen this coming, if I'm completely honest. And they haven't been very good to savers as well. Their interest rates are very, very low. I was hearing that some stable coins wanted to pay 4% yield. That's quite a lot. That is quite a lot. So if stablecoin yield is restricted, what would that do for stablecoin adoption?
Well, that's hard to predict for the actual stablecoin industry. I mean, the unintended consequences could be a path to a CBDC. Because if you want to get dark here, maybe this whole thing about talking about stablecoins is nothing more than smoke and mirrors to actually one day create a CBDC, which, is a central bank digital currency, which allows them to, control your behavior because they can control the wallet that your coins are in. That's like the nefarious angle, right? It's like if they hurt stable coins, it's a signal they really want a CBDC. And we do know that there are elements of governments, or all of the elements of governments, that want to control your life.
Yeah.
The other idea is it just allows for some other different type of innovation, some other layer one or some other crypto asset that's not a stable coin starts paying a yield. I don't know. I know that they're not. I mean, it's like, you guys want to limit stable coins? Okay, well, good luck with that 11 trillion you got to issue this year. Let us know how that works out.
Because that's something that they do want to do, or something that they have been talking about, or what has been spoken about is actually selling bonds to stable coins, which I actually think on their side is actually quite a good idea. It's another place to park their debt.
Yeah. I mean, it creates a huge buyer for all assets, treasuries, stocks, Tether. Tether is a gold whale now. Right? I mean, these stablecoin companies, they're enormous. So they want treasury assets, and if we don't do it, someone else will. The English, the Japanese will be like, oh, you guys want to limit stablecoin yields in the United States? Oh, come on over here. Well, do a yen stablecoin. We got some debt we need to sell you.
And it's amazing how fast all of this has actually come about, because stablecoins, I think they came out round about 2013 or 14. but they only kind of picked up after 2017, around about that bull run and that bear market, but they really picked up last, the last 4 or 5 years in 2021. So yeah, it's this innovation in crypto, it's going like literally full steam ahead. We can't even keep up with it. Lots of new things coming out. Okay, let's talk about, we're getting through this quite quickly. Let's talk about Japan. Now, Japan has had its snap election, and it was won, as predicted, by the sitting liberal, the LDP party, who secured a 2/3 super majority in the lower house. They won 316 seats out of 465 seats. And now that matters because a 2/3 majority in the lower house can override the upper house rejection on ordinary legislation. So that gives the party a much stronger mandate to push through economical policies. Now, markets immediately read this as a high probability of stimulus, more spending, potential tax changes, which usually implies government borrowing and more bond supply. What this means for banks is that higher yields are obviously a double-edged sword. On the positive side, if yields rise in an ordinary manner, banks benefit from better returns on new lending and new bond purchases, which improves profitability over time. On the risk side, however, Japanese bonds and issuers already hold a lot of bonds from the ultra low rate era. So when the yields jump, the market value of those existing bonds portfolios, they fall, even if they don't sell. That money is tied up in older bonds, low earning paper, than it is with the newer bonds that are now available. It's a bad taste. That same money could be earning more money. And if institutions are forced to sell realized losses, i.e., sell into weakness, that's where the pain shows up. Now, the swing factor is how the Bank of Japan responds. Right now, the higher yields, like the 4% that we get, that we hear about, is on very long dated bonds, like the 40-year terms, where the 10-year benchmark has been closer to the lower 2% range. If the physical expands and stronger growth expectations push yields up further, the Bank of Japan either has to let rates rise or put a cap on the speed of the rise so it doesn't break the system. Now, higher yields obviously mean the government has to pay more interest on the bank. It costs them more. It costs them more, and it can pressure bank and issuers to hold a lot of those older bonds. They kind of want to sell, and in response, many can de-risk, shortening bond durations, hedges, and some selling holdings and tighter lending. So it kind of seems like the LDP plan requires a lot of stimulus. They want to, do all these tax cuts, military spending, and just investing in their infrastructure. Now, after decades of low rates, does a sudden shift towards high rate Japanese government bonds risk shocking the market, or has that outcome already been priced in, and is it expected? And on top of that, actually, I will ask this now, it's also effectively punishing domestic banks, isn't it, and the issuers, because they did the patriotic thing. They were buying Japanese government bonds when yields were near zero, and leaving them in large unrealized losses, isn't it?
Okay, so it looks like all this was priced in. I don't know if that's true. I think what's really happening is somebody got elected with a mandate, a big majority, and the Bank of Japan is not going to allow, neither is the Fed, to have their bond market go hysterical and embarrass the new leaders. So QE is in effect. I think it's in effect in our country and their country. Like, our interest rates are down, their interest rates are down. Like, so both bond markets are trading well. So I think there's coordinated QE going on, whether we could see it or they admit it or not. They cannot have Japan falling apart. And we've talked about this. Now, the Japanese people need a bailout at the grocery store. They're getting destroyed. They're getting destroyed, right? The inflation, the food inflation, and things like this in Japan is insane. So I think they're having it's almost like a MAGA moment, right? They're dreaming of something different, right? So they're going to get they're going to bring the Japanese military back. They're going to bring back the samurai. They're going to bring back, let's be proud to be Japanese again. Let's spend a whole bunch of money. Okay. They're not punishing the banks. The banks and the central banks, it's all the same thing, especially in Japan. It's the same thing over here too. I think the people who are getting hurt over there are the Japanese people. I mean, you really need to understand the disillusionment in this like MAGA movement in the United States. Like, people really thought this time was different. The 5 most dangerous words in the English language. This time is different. It's not. It's not different. Governments are acting on behalf of special interests. And how does this help crypto? Because you know what, folks? Everyone just wakes up one day and goes, you know what? I'm leaving the system. I want out of this. I'm done. Right? This has happened in the U.S., and it's probably going to happen over there too, especially if there's an interest rate reckoning or a currency reckoning. I mean, right now, dollar yen is stable, and thank God for that, because we've talked about this too. Nobody wants a disorderly move in financial markets, because when you get these type of disorderly moves, like in rates, or most people follow gold and silver, up only and then down 30%. You know what? When you have those kind of moves, I can guarantee you one thing: at Wall Street, somebody blows up. Computer models are not designed to handle that kind of volatility. The slang you hear is in statistics, like it's 6 sigma, or it's so far away from what normally happens. They use all these expressions, tail events, and you don't need to understand that. What you need to understand is Wall Street works on what should happen. And then if some wild, crazy thing happens, someone winds up getting liquidated. And you're like, oh, well, we're like the Muppets in crypto. We're like, well, of course. That's what happens in crypto every day. Yeah. It doesn't happen in legacy every day. And when people get liquidated, that's when there could be big events. And, generally speaking, we're witnessing it, right? We're witnessing Bitcoin suffer. Americans are disillusioned. I hope it doesn't happen to the Japanese, but it probably will. They've been doing this since the 90s. I mean, Robert Kennedy, the guy I liked for president, he's currently like a health secretary. If you spend $1 million on defense in the United States, how many jobs does that create? One. So you'd have to spend a lot of money on defense to create a lot of jobs. Whereas he would say, if you spent $1 million on like childcare or like daycare, I don't know, somewhere between like 12 and 30 jobs. Chatbot it later. It's a lot more jobs for your $1 million. So the people who wind up getting ripped off here are the voters, are the human beings. And this goes back to the Clarity Act. They just have to make it legal for you to do crypto because of the type of things that they do in Japan, where they're just going to spend the country. They have a demographics problem. That doesn't get fixed. Mm-hmm. Maybe it gets fixed with robots. It doesn't get fixed through anything traditional that I know of. So, crypto has to be preserved for the people as a way to offboard from legacy. And the great news is, they debanked. They not only debanked the president, they debanked his wife and children. You know what? If you debanked my wife, girlfriend, and children, I would get a Clarity Act passed to push back against the banks. We all need to push back against banks and governments and these big Wall Street firms because they do what's in their interest, not in ours. And I say that in context of the Japanese question. And we just talked about this on one of our podcasts. We don't want people to get pushed out of crypto because of this event. We don't, right? It's like if you got pushed out of Bitcoin at 16K and then it 10x'd. That's Bitcoin, right? We don't want that to happen to people. We don't want that in this case because this time you're going to really need it. Like when the Optimus robots start walking out of the Tesla Gigafactory in Austin, it's going to look like stormtroopers from Star Wars, right? When the labor force replacements start walking themselves out to a parking lot, the idea of cryptocurrency is going to be very important at that point for humanity. So the Japanese can elect whoever they want. I wish them well. I would love to bring the Japanese army back. I'm not a big fan of communists. And I'm sure they will do exactly what the Americans do and make a big enemy out of China so they can do what they have to do. Classic propaganda stuff. Again, are we all going to fall for the propaganda? I have a great idea. Let's watch the Crypto Princess live stream, learn about crypto, and not do that.
Mm-hmm. What normally happens? So we've got the domestic banks, and they've been doing, and others who've been doing the patriotic thing. They've been buying the Japanese government bonds for decades, especially when the yields were near zero. They are sitting, or they will at some point be sitting in large unrealized losses. What would normally happen at that stage? Will they sell and go in and buy the more attractive bonds?
Honestly, what would probably happen in a normal, like 2008, then they would either be bought by somebody else or the central bank would just literally absorb the entire entity and then slowly liquidate that entity's securities. In this particular case, I think the Japanese banks would sell the bonds to the central bank at a very favorable price. In other words, the Japanese government bond market has fallen apart to such a degree, it has to be guaranteed or is implied to be guaranteed by the Bank of Japan. So the thing you may not have to worry about is the bond market, but you may have to worry about the currency because this is like infinite printing. If they ever had to fix the banks or if they had to do helicopter money to save their citizens, what happens to the currency? That's the big concern over there in Japan. Are you going to have to worry about that in election day? No, because central banks are making sure it's okay. Like, okay, the market had its fun and they let them do the big trade. And now it's all going the other way because of profit taking and because central banks don't want a nightmare. They don't. Can't have it. We talked about this. Like Powell set it up. It's the only time you've ever seen Jerome Powell cooperate. He's like, yeah, we have a dull yen facility ready. The yen is not falling any further. That's it. And that stopped it.
So at what point does raising the yields become a problem rather than, rather than normalization? So what I'm trying to say is, when does rate raising stop being healthy and starts to become a problem?
I call this the embarrassment factor, right? In other words, if a central bank has lost control of interest rates, or if the market has taken control of interest rates in the country, because that's really more accurate, right? If you have a bond market that's collapsing, the market has just decided that long-term interest rates for your country should be massively higher. And that's embarrassing. And, parliamentary governments have this no confidence vote thing. It's the worst kind of no confidence vote you can have because the public has to sit there and watch this unfold. People are not stupid, right? They see credit cards, they see mortgage rates, they watch the news. Okay. Even a patriotic people like Japan. So it has to do with the embarrassment factor, right? It's the same thing with treasuries or S&P. I mean, how many times has Trump talked about, well, the stock market's doing great, right? It's they can either be proud of it or it can embarrass them. So it becomes a problem when people start losing confidence in the government and then potentially the currency. It also becomes a problem if some hedge fund and the risk management models aren't programmed to handle the way it accelerates. See, there's like, how fast are you going? Like, you could be going 80 miles per hour in American terms. But if you're accelerating at 10 miles an hour, you're not going at 80, you're going 80, 90. It's the acceleration factor in these moves that matters, like silver, right? Go, 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 and then down 30%. It's massive volatility. That is what is unhealthy. That is what is toxic. Now, of course, legacy can go out and get as toxic as they want. Because at the end of the day, right, like, you got to think about this. Bitcoin should have followed gold and silver higher. Gold is at $5,000 an ounce. That's robust. That's huge. Silver was at 125. When Bitcoin is at 69, you got to imagine a day when, Army Piper gets off the plane from Fiji, all super tan, whether that's in April or October, and comes back in to trade the bottom of the 4-year cycle. And you got prices that Wall Street is giving you that are just so unbelievably low, because Bitcoin is going to do what silver did and then some. In other words, here's an outlandish, ridiculous thing. What would happen? Ready? What would happen if Bitcoin went to 40K or 30K? Because some people are talking about that right now. That's the talk. It used to be 250K. Now it's 30. What would happen if Bitcoin went to 30K and then turned around and 10x'd? It's 300K. Right? That was a middle of the road target a year ago on the election. Could that happen? Could you get 30 and then could it turn around in 10x? Well, look at the silver chart. Look at the gold chart. It can happen. If they push out the ETF tourists, it can happen. So I mean, we were talking to a lot of our members, we're talking to our community about, hey, this is why you don't want to get pushed out of crypto. Because when this is over, people are going to say, wow, look at the way all these governments, all these corporations, look at all of this behavior. What do you want to do? One word: exit. It's Bitcoin. Even the cat knows it. You know what I'm saying? The cat's like, hey, mom, get off the stream, buy some Bitcoin,
Okay, no, that's brilliant. Okay, so today we spoke about the God candle. So it was the first time, although we've had God candles in the past, we've had like half a dozen. I'm not entirely sure, but it was the first time that we've literally had a God candle where the actual body of the God candle was $10,000 or more. We spoke about the liquidation event that led up to it. Obviously, the macro events that also led up to it as well. We spoke about the Clarity Act, what the Clarity Act is, the two parts of the Clarity Act that we spoke about. We spoke about the banks and the stablecoin yields as well. We spoke about the Japanese election and what could be coming next in Japan with all their money printing, all the stimulus that we think that they're going to be doing, and how that could affect bond markets. And then again, how everything could affect crypto. That was a really good live stream. I've learned a lot. We've covered a lot as well. So tomorrow I've got Jason Casper on the show. Do you know Jason Casper, Bill? He's a trader.
No, I've seen his picture.
Yeah. So Jason Casper's on the show. So do join us tomorrow for that. I don't normally go live on a Wednesday, but I will be. And then on the Thursday, we'll be going through 2011. Now, 2011 was a year where we had a top and a bottom. So we'll be going through that. We'll be going through why it happened and all the rest of it, and where it fits into the 4-year cycle, or if it doesn't fit in, etc. So that's brilliant. Thank you so much for joining us, and I'll see you all tomorrow when I'm joined by Jason Casper. Thank you so much, Bill. Thank you for being here with us.